When one company invests in another, it's not always some big, dramatic takeover. A lot of the time, it's about getting a voice, a seat at the table. But how much of a stake does it really take to have a real say? And more importantly, how do accountants actually capture the value of that influence on a balance sheet? Okay, let's dive into this and unpack the rules that govern these really powerful relationships. So, here's our game plan for this explainer. We're going to start with the trigger point for all of this, the influence threshold. Then, we'll look at the different accounting methods you have to choose from. After that, we'll really get into the nitty-gritty of the equity method, compare how it applies to different business structures, and finally, we'll wrap up with why this specific type of accounting is so important. So, first things first. At what point does a simple investment become something more? This section is all about defining that line in the sand. Yeah, that really is the million-dollar question for accountants, isn't it? Influence can feel a little vague, right? But in the world of finance, it needs a rock-solid definition so that everyone is playing by the same set of rules. So how on earth do we measure it? Well, here's our starting point, the big number. The general rule of thumb, according to accounting standards, is 20%. If an investor holds 20% or more of another company's voting power, we presume they have significant influence. And that's the main trigger that makes them switch to a completely different, much more involved method of accounting. But here's what's really interesting. That 20% rule, it isn't set in stone. You can actually have significant influence with a smaller stake. Accountants also have to look at these other, more qualitative factors. For instance, having a seat on the board of directors. That's a massive indicator of influence. Same goes for being involved in key policy decisions or having essential tech shared between the two companies. It's really about the substance of the relationship, not just the percentage on a piece of paper. Okay, so once we've established that, significant influence exists, we can't just treat the investment like any other stock we own. We have to use a very specific method. Let's move on and see what that choice actually involves. Before we get to the methods, let's just lock in this official definition. The key phrase here is power to participate. This is such a crucial distinction. It means you're more than just a passive bystander, but you still fall short of having outright control. You're in the room where it happens, but you don't necessarily have the final say. So, here are the two main paths you can take. Without significant influence, an investment is usually measured at fair value, which is basically its current market price. Simple enough. But once you cross that influence threshold, you have to use the equity method. And the key difference is this. The equity method isn't just about what the stock is trading for. It's designed to reflect your share of the other company's actual performance. This is huge because it means their profits and losses directly impact your income statement. And this little decision tree illustrates the whole process perfectly. The first question an accountant asks is, does my company prepare consolidated financial statements? Those big reports that combine their financials with any subsidiaries they control. If the answer is yes, they'll use the equity method in those big picture reports. If the answer is no, they just jump straight to using the equity method in their main financials. It's a clear roadmap. All right, we've talked about the what and the why. Now it's time to get our hands dirty with the how. This section breaks down the actual mechanics of the equity method. It really boils down to 3 core steps. First, the investment gets put on the books at whatever you paid for it. Simple. From there, its value starts to change. If the company you invested in makes a profit, your investment's value on your books goes up. And third, and this is the tricky one, when you get a dividend, it's seen as a return of your investment, so the book value actually goes down. Let's look at the journal entries to see how this works. The logic here is pretty intuitive, right? You have influence, so you share in their success. If your associate company reports $1 million in profit and you own 30%, then your share is $300,000. And that gain makes your investment more valuable on your books. And here's exactly how accountants put that on the record. They debit, or increase, the value of the investment in associate asset. At the very same time, that share of the profit is recognized as income on their own income statement, which boosts their bottom line. Okay, now this next part is absolutely key. Under the equity method, a dividend is not revenue. And you might be thinking, why not? Well, it's because you've already recognized the profit that made that dividend possible in the first place. So instead, the dividend is seen as the other company giving you a piece of your own investment back. So this journal entry shows that swap perfectly. The company records that it's about to receive cash, that's the dividend, but instead of calling it new income, they credit or decrease the value of their investment in associates account.
They are, in essence, just trading a piece of their investment asset for the same amount in cash.
Now, the equity method isn't just for these associate relationships. It also pops up in other business structures where influence is shared. Let's see how this all works when we start talking about joint arrangements. First up, we have joint ventures. The magic words here are net assets. What this means is that the investors in a joint venture have a claim on what's left over after all the debts are paid. They share in the overall entity, the whole shebang.
A joint operation, though, is a different animal. Here, the partners don't just have a claim on the final net value. They have direct rights to specific assets and are directly on the hook for specific liabilities. Think of it like this. You own a particular piece of machinery, and you're responsible for a specific loan, rather than just owning a share of the whole company.
And this slide just nails the accounting difference. For joint ventures, because they have rights to the net assets, they use the exact same equity method we just went through. Easy. But for joint operations, it's a completely different playbook. They don't use the equity method at all. Instead, they bring their specific share of the assets, liabilities, revenues, and expenses directly onto their own financial statements.
So we've gone through a lot of technical detail here, but why bother with all this complexity? In our final section, let's zoom out and look at the big picture. Because this isn't just some accounting exercise, it fundamentally changes how we see a company's real value. So why is this method so darn important?
This quote just gets right to the heart of it. If you only track the cash dividends you received, you'd get a really choppy and honestly misleading picture. Think about it. A company could be wildly profitable but choose to reinvest every single penny to fuel its growth instead of paying out dividends. In that case, just looking at dividends would show you a return of zero. But the equity method correctly shows your investment's value is growing right along with the company itself. It gives you a much truer, more continuous picture of what that investment is actually worth. Now, there's one really important exception to all of this, and it's called materiality. Accounting standards, like ASB 128, which covers this stuff, have a built-in common sense filter. If an investment is so small that how you account for it wouldn't possibly influence the decisions of someone reading the financial statements, then the company doesn't have to go through all the trouble of the equity method. So the next time you're looking at a company's balance sheet and you see a line item for investments in associate, you'll know. You'll know it's not just a passive number on a page. It's a story about a relationship, about having a seat at the table, and about sharing in success. The real question is, are you just looking at the assets, or can you now see the influence behind them?